Oil prices rise 2% as Syria's president flees the country and as more stimulus is expected in China after a surprise politburo statement last night. The Aussie and Kiwi dollars get a boost, and the RBA goes into its final meeting of the year with a slight tightening bias. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's Executive Director for Agribusiness Insights, Michael Whitehead, has been down on Australia's wheat, beef and sheep farms and has mostly good news for farmers, starting with strong grain prices and a surprising reason.
A stat that's not being talked about much is that so much of the world's wheat in storage is in China that the figures for wheat in storage outside of China are at a multi-decade low.
But first, in 5 and 5 with ANZ, oil prices rose around 2% overnight as the fall of the Assad regime in Syria contributed to greater uncertainty, but also after indications of further stimulus in China. More on that later. By 4 a.m. Sydney Melbourne time, West Texas was up 2% at $68 a barrel. Other market reactions were fairly muted, with the S&P 500 down 0.4% at 4 a.m. and the US Treasury yields up between 2 and 3 basis points. Attention this week internationally is on US inflation data for November on Wednesday night. ANZ economist Bansi Madhavani says from London that if prices rise faster than the 0.3% expected, the Fed could have a case to consider pausing rate cuts.
The FOMC now is in a blackout period, but prior to that, we did hear policymakers speak about the economy approaching the point where Fed can slow rate cuts. We are certainly of the same view. We think Fed is on the cusp of slowing its rate cutting cycle. However, we continue to see case for a 25 basis point rate cut at Fed's December meeting, so long as inflation does not accelerate. Currently, markets are pricing 86 to 87% odds of a 25 basis points rate cut in December meeting.
At 4 a.m. Sydney Melbourne time, the US dollar index was down 0.14%. The Aussie dollar was up 1.1% at 64.60 US cents, while the Kiwi was up 0.88% at 58.78 US cents. Number 2, China's authorities surprised markets yesterday by releasing a communique from a politburo meeting ahead of the hotly anticipated Central Economic Work Conference. It was earlier than expected and included some unusual wording around the need for an aggressive, counter-cyclical fiscal stimulus. Here's ANZ Greater China Chief Economist Raymond Yung.
So they have used new wordings in describing the economic policy, and the overall approach is to increase the domestic consumption and to improve efficiency of investment. Also, they apparently want to acknowledge the external risk from the Donald Trump government next year. So we would expect that a lot more stimulus from the fiscal side will be coming over the next few months.
Number 3, the Reserve Bank of Australia holds its final board meeting of the year later today. ANZ Head of Australian Economics, Adam Boyton, says there is a slight tightening bias heading into the meeting after the RBA said in November that it would take some time for inflation to get back to target. Adam expects the first rate cut in May.
I think to get a rate cut in February, and that would mean some softer labour market data. We get an update on the labour market, of course, on Thursday this week, but also some good inflation numbers, in particular the all-important Q4 inflation number at the end of January. My assessment at the moment is that conditions in the labour market have been sufficiently strong over the past 6 months. The Reserve Bank Board won't feel in any hurry to cut interest rates to support the activity side of the economy, unlike what we've seen in some economies overseas, of course.
Number 4, China's annual CPI inflation rate of 0.2% in November was down from 0.3% in October and was also below market expectations for 0.4%. ANZ senior China strategist Xiao Pengxing says a sharp fall in food prices were a major reason for the weakness.
The food price dropped more than expectation only because of the demand issue, because we just after the holiday, so the demand usually very weak in November because people will start buying in December, not in November. Another big reason is the weather. China has a very warm winter this year, making the food supply ample on the market. So the food price is still under pressure in December.
Number 5, China's producer price deflation was, however, more robust than expected, albeit still a fall of 2.5% for the year and up 0.1% from October, which was itself down 0.1% from September. Xiaopeng says the rise may be temporary, given it was largely linked to a rally in commodity prices in late November, linked to expectations about a big new fiscal stimulus, which hadn't eventuated as of yesterday morning.
China domestic commodity price like steel, aluminum, and copper rise significantly in the second half of November, making the PPI headline PPI number higher than October. I think this is not a long-standing trend because all the rise in the commodity price built on the expectation on policy meeting. I think the Central Economic Work Conference will not give very detailed stimulus about next year. So after the meeting, I expect PPI may drop again.
Xiaopeng there. Now, in our bonus deep dive interview, ANZ's Executive Director for Agribusiness Insights, Michael Whitehead, has been down on Australia's wheat, beef and sheep farms and has mostly good news for farmers, starting with strong grain prices.
There are three big things that could really impact grain prices going forward. They are Russia, China and the US. With Russia, they have just announced that they are going to drastically cut their wheat exports because of domestic inflation pressures. And that could really have an impact on prices if countries have to go looking around for more grain. Secondly, China. And a stat that's not being talked about much is that so much of the world's wheat in storage is in China that the figures for wheat in storage outside of China are at a multi-decade low. And that would normally push prices up, and that's one to be watched closely. And the third one is the potential fallout of the Trump tariffs. If they come into place, and if China chooses to retaliate, for example, will this impact China's imports of, say, American soy? And could that benefit Australia and other countries when China imports more of Australian wheat, more of Australian canola, and other things as well? So three things to watch.
Why is there so much stored in China?
China likes to keep an awful lot of wheat stored for a few reasons. It helps them pull the levers when they need to. If they have a low domestic crop, as they do sometimes, they've got a whole lot saved up so they don't have to rely on world markets. And they always like to keep a lot of these things in storage so that if for any point there are sudden trade issues, that their people aren't going to go hungry.
And just looking at beef for Australia with the outlook for not just trade with the United States, but also what's happening with demand and supply globally.
Yep, look, it's a really interesting point with beef right now in the world because the world's biggest beef producers outside of Australia are all seeing their herds go down. Brazil, the US, EU and China. And for the first time in years, there is going to be a fall in global beef supply. So that puts Australia in a really good position that China will need more of Australia's beef. The US, with its herd at a multi-decade low, continues to need a lot of Australian beef. And who knows what's going to happen with their Mexican and Canadian imports as well. And at the same time, Japan and South Korea is now Australia's second biggest beef market, are also importing strongly. So all the export signs, and Australian beef exports are at record levels, continue to be good.
So how are farmers thinking about this? Are they planning to take on more stock, expand their land footprints? What's happening?
They absolutely are taking on more stock. We've seen that in the last week or so, with some very good rains in Queensland have meant that the restockers have rushed into the yards to build their herds up again. So you'll see that minor growth in herds. In terms of expanding their footprints, not necessarily. You'd argue in a way that the Australian land usage between grain, sheep and cattle has sort of reached an equilibrium right now. So they will restock. There will be more grass and prices are good, and that will grow the herd number for the time being as well. But you're not going to see a massive change.
Just looking at dairy again, the outlook doesn't seem quite so positive for farmers, but what's happening there?
Look, dairy continues to be an interesting one because it's changing structurally. Dairy farms in Australia remain small compared to the ones in New Zealand and other big producing countries. Australia continues to see more imports of dairy, and a lot of Australian dairy farmers are choosing either to sell to a beef farmer next door, or they're choosing as well to perhaps get out of the industry to move on to something else. So it's an industry that continues to get smaller. Global dairy prices aren't looking too bad at the moment. So for those who are staying in dairy, that looks good. But we're also seeing a change in the processing side in Australia. Because there's less milk, there's a need for less processing operations, and we'll see that contract further in 2025.
Michael Whitehead there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, December the 10th. Catch you tomorrow with all the detail from the RBA decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.